Research shows there's 6 common mistakes consumers make when shopping for a mortgage. In this video, I'm going to break down the 6 secrets to finding the best mortgage rate and program for your situation. Hey, my name is Chris from OneRate. We're a mortgage broker located out of the Washington, D.C. area, and we're licensed in 15 states. We've been helping people just like you with their mortgages for a combined 50 years plus. If at any point in this video, if you have any questions about the mortgage process, feel free to reach out to me directly by texting 240-292-1663 or emailing me at chris@onerate.com. All right, now let's get into it. Step 1. Getting pre-approved and not pre-qualified. I've mentioned this in my 10 steps to buying a home video, but it's one of the most common mistakes borrowers make. They unfortunately think that speaking with a lender and getting pre-qualified is good enough to start looking at homes. Unfortunately, this can lead to a complete waste of time for everyone, including yourself, because there are components of the loan approval process that's done early on at the pre-approval step to make sure you can actually afford the home you're anticipating to look at and buy. When you get pre-approved, the mortgage professional will not only calculate how much you can afford, but review your loan application against underwriting guidelines to ensure your loan will get accepted and approved if it goes into underwriting. This in itself is very different from a pre-qualification because a pre-qualification is only a verbal verification of your affordability based on the information you provide to the mortgage professional. A pre-approval typically requires a loan application, like I said, supported with a bunch of lists of documents so that the lender can determine your approval possibility if you make an offer on a house and your offer is accepted, thus starting the whole mortgage process. So during the pre-approval process, the lender is going to run your credit, review your income, liquid assets for a down payment and closing costs, and confirm your profile meets that loan guidelines. And additionally, most realtors won't even show you a home if you're not first pre-approved. Step 2, monthly payments. Another mistake that home buyers make is not calculating their monthly payment correctly. When lenders calculate your monthly housing expense, it's a combination of your mortgage payment, monthly property tax, monthly homeowners insurance, and homeowners association dues if there is any, and sometimes known as also condo dues. Understand, each month you'll make a monthly payment to your lender that will go toward paying back the amount you borrowed, commonly called the principal, plus interest. Your monthly payment may also include mortgage insurance. Your mortgage statement will show how your payment is broken up. Initially, the bulk of your payment is going to go toward paying down that interest on the loan. But over time, as it goes by, more of your payment will go to paying down that principal balance. If you have an escrow account on your loan, part of your payment will go there. The amount of money that's added to your payment for escrow depends on the amount of your property taxes and insurance premiums. Your lender is going to analyze your account each year to make sure they're collecting the appropriate amount of money, and they'll adjust your payment if they're collecting too little or too much. Lastly, you can't prepay a few months of mortgage payments in advance. You have to pay your mortgage monthly until the loan is paid in full. Step 3, thinking long-term. It's critically important to consider your long-term strategy of home ownership when shopping around for a mortgage. For example, if you have the cash readily available, you may be inclined to consider paying points to buy down your rate so that your mortgage payment is less. However, you have to consider a few factors before making this decision. One factor is there any impending recession that's about to come? Since mortgage rates are tied to inflation, if a recession comes and inflation is curbed, mortgage rates will drop as well. In this scenario, it wouldn't be wise to pay points when the cost of refinancing can be the same or less for the same or better rate in the near future. Another factor to consider in this scenario is how long are you planning on living and keeping this home? If you're planning to live at your new home only for a few years and you don't get a chance to experience the benefits of the rate reduction by paying points, it wouldn't make sense to pay the extra cost to lower your points. So a simple way to understand if paying points is worth it for you is to do a simple break-even analysis. A good mortgage professional should be able to help you with this. There are so many other examples to consider, but a good mortgage professional should be able to walk you through these during your initial consultation with them. Oh, and before I forget, leave a comment below if you want me to connect you with a trusted real estate agent in your area. Also, be sure to subscribe for more insider mortgage content. Now, step 4, understand your payment. I spoke briefly about your housing expense, but I want to elaborate further about certain ideas to consider. Remember that your mortgage payment is made up of a principal and interest. Additionally, if your down payment is less than 20% of the value of your home, For a conventional loan, then most likely your mortgage payment will also include mortgage insurance. FHA, the mortgage insurance is not going to go away, so just be on the lookout for that. But the mortgage insurance amount will vary based on your credit score and the size of your down payment. You should know that for a conventional mortgage, the mortgage insurance will be removed automatically if the loan amount drops below 78% of the value of the home when your home was purchased. If the loan amount drops below 80% of the value of the home when your home was purchased, you can call your loan servicer to request the mortgage insurance to be removed. Again, depending on if you are escrowing your property tax and homeowner's insurance, your monthly payment may or may not include those two costs. Depending on your scenario and if you are financially responsible, you can choose to not escrow your property tax and homeowner's insurance, but know it will be your responsibility to save and pay them on time every single year. This is usually a few thousands of dollars a year that you're going to need to put aside for these two costs. Number 5, what determines your interest rate? I have a video that goes into detail about this topic, and I'll link it in the description below, as well as here to my right. However, to summarize, there are 11 factors that determine your interest rate. 2 of these factors you don't have any control over, and the 9 of these factors you do. The 2 factors are what I call external, and they are 1, financial market, since rates are tied to Wall Street, and 2, the revenue percentage a lender is earning for each transaction. This is basically baked into the rate, and typically you can't change it. Now, the 9 areas that you control that impacts your mortgage interest rates are property types such as single family home, townhouse, or condo, occupancy type such as primary home, vacation home, or investment property, mortgage term desired such as 15-year fixed or 30-year fixed or anything in between, loan products such as is it a conventional loan, FHA loan, or a VA loan, or etc. Credit score, so what's your credit score? Down payment amount, how many days you need to lock the rate in order to close this transaction, number of units for the property, and property location. Now, all of these 11 factors combined determine the mortgage interest rate you'll receive. And by the way, because one of the factors is that the rates are tied to the financial market, the rate will fluctuate daily. So a quote today and a quote tomorrow are 2 totally different quotes. And you're basically comparing apples to oranges. So the pro tip is to make sure you request quotes in the morning so that you can get it all within the same day, and at least you are comparing apples to apples. All right, the last tip, number 6, work with a mortgage specialist, not just a bank employee. For this tip, instead of hearing from me, a mortgage broker, which would sound a bit biased, why don't you take a listen from a top realtor in Maryland, Kevin Grolig?
I contacted you. We spoke on the weekend. I never forget it. And I just said, hey, Chris, I'm working with these clients here. My understanding is you are too. Yep, Kevin, nice meeting you. Thanks for the call. And we talked about it and we kind of collaborated right over the phone. And I said, this is what I need. This is what I expect. I want to make sure you can deliver. I expect, I'm not a jerk. I'm not going to call you and text you and bug you in the middle of the night just to bug you. But you know what? I need to know that if these guys find a property and I need a pre-approval letter at 8 p.m. on a Thursday, that you're at least going to be responsive to me and you can at least have something to me by the next morning at best, preferably sooner than that. I also need to know that you're willing to pick up the phone, make a phone call to that other agent who's representing the seller to once again be that 1-2 punch between me and you, advocating for the buyer, making sure our story lines up together, that it's not like I'm saying one thing and you're saying something completely different, to make sure that our case is rock solid. That's advocating for our, your customer, my client there. And so it became, it only took me 10 minutes on the phone to realize that you had that level of professionalism that they needed to be successful. And at that point, it's like, I don't need them going anywhere else. If they had a mortgage lender who was at a credit union and like, I can't return calls after 4 p.m. I'm going to tell the buyers once again, hey, your choice, you can use them, but I'm going to tell you, you're going to lose some houses. Are you prepared to lose some houses? Because if you are, then that's okay. Actually, it's not okay, because it's not okay for me. It's not okay for me to be putting my time in when you're working with somebody who's completely inferior on the other end. So, that's kind of how you and I met and everything.
Yeah.
And that transaction was super smooth. I mean, I think we closed it in 2 weeks or whatever. No problems whatsoever. And so, that's I became a big believer then.
I hope you got some value from this video, and if you did, be sure to check out some of my other videos on YouTube listed below. Now, there you'll find more mortgage tips and advice, as well as many other resources to help you through your home buying journey. If you have any questions, just shoot me a text at 240-292-1663 or email me at chris@onerate.com. And I'm sure my team and I, we're going to be excited to help you along your journey. Thanks again for watching. Have a great day.